Okay, Whitney. Whitney's nodding her head. Welcome, Stephen. Welcome, Pam. Welcome, everyone, to Tax to the Max, the March 3rd edition with special guest Larry Pon. He'll chime in here anytime he's moved to do so. This is, if you're familiar with this program, you've seen this disclaimer before. What I want to emphasize is the value of my subscription to Tax Notes Today. Tax Notes Today is published by tax analysts, which is, in my opinion, the preeminent source of current information for tax professionals, very much in touch with what's going on in Washington, D.C., inside reporting at the IRS, so that we get information from the IRS literally overnight. What's on the program this week? Remember that last week or 2 weeks ago, we added information about the South Carolina Department of Revenue. So we're going to talk a little bit about that first thing this week. Archiving of frequently asked questions, something that we had recommended our clients do privately, that they archive any frequently asked questions that they relied on. Now the IRS has it all set up for us. So all set up for us may or may not be exactly the operative term. Regulations, clarify tax payments that are eligible for the foreign tax credit. That's useful. We've talked about that now. This is the third week that we've had some kind of comment on these regulations. I think we're going to button it up this week. No tax exempt status for a scholarship program. And the question is why? Why not, right? Why couldn't the company give scholarships to the children of its employees who qualified by academic achievement or by need? A new fact sheet on the premium tax credit. I may even encourage Larry to comment on that one. And then finally, Larry's part of this program, an update on the Secure Act regulations, including updated required minimum distribution rules. Here's a little bit about Larry. Larry, you want to introduce yourself and just say hello? I think you're not muted, so.
Hello, everybody. I'm Larry Pon. I'm a CPA here in River Shores, California. I'm in my 36th tax season, so living the life like you guys are. So I'm looking forward to talking to you a little bit later. Also like to add what Lynn talked about tax notes. I subscribe to their podcast. So I'm the only guy at the gym listening to the Tax Notes podcast. I highly recommend you subscribe to that. It's been very good, very timely.
Thanks, Larry. If you have questions, please post them in chat. I will see it. I get a little red check mark when a question is posted in chat here, or you can post it in the SCAPA Connect, or you can unmute yourself. And if you don't mind holding your hand up, there's a little button. Everybody seems to know all about this stuff except me, but I'm learning. There's a little button you can press, which will wave your hand at me, and I'll know that you have a question, and we'll just open it for discussion. This program is not that formal. It's not that structured. We want everyone to, number one, learn something, and number two, have a good time while we're doing it. South Carolina income tax for individuals. Here, as I undertook to become familiar with what was available here, the resources include this website, this link. The starting point in determining South Carolina taxable income is federal taxable income with certain modifications for South Carolina. And of course, it's subject to allocation and or apportionment if you have multi-income from more than one state. The South Carolina Department of Revenue has prepared this tutorial explaining how South Carolina's individual income tax works. There's the link. It's live. If you download these materials, you can, to your computer, you can click on that link and it will take you directly to that tutorial. I thought the tutorial was really helpful since I'm not native to South Carolina income tax laws, and I don't always have the best understanding, or I don't always have confidence in my understanding. This has given me more confidence to talk about South Carolina's individual income tax law. Then there are the sales and use taxes. we concentrate on income tax and we forget about sales and use tax until we have a mistake or a series of mistakes and we have an audit and we have a deficiency. We have to put up with the pain in the butt of having an auditor go through thousands of transactions. South Carolina is not a member of the Streamlined Sales and Use Tax Agreement. Therefore, compliance in South Carolina is a little bit different. Two neighboring states, Georgia and North Carolina, are full members. Tennessee is an associate member. And in my view, that makes it extremely important for a tax practitioner in South Carolina to understand sales tax rules in all of these states, because it is unlikely that a client of any size is going to have their trade or business restricted to South Carolina. If they're selling things, they'll be selling things, and especially with internet sales, they'll be selling things and delivering things in different states. We need to know what the laws are so that we can comply with whatever the rules are in that particular state. Particularly important given the Wayfair decision. This training is free. Now, you may not need this training yourself, but there may be someone in your client's employ who should get this training for just a simple sales tax workshop coming up on March the 22nd. This is South Carolina sales tax law, period. But on April the 14th is a sales and use tax seminar for the manufacturing industry. And this is really one of the places where the rubber meets the road for sound tax compliance, because of the use tax rules that apply to things that are purchased by a manufacturer that are either used in or consumed in the manufacturing process. What about sales tax on gloves, where gloves are necessary safety equipment? You can answer that question if you attend this sales and use tax seminar for the manufacturing industry on April the 14th. And we'll keep these notices up some way or another, not on the front end, but maybe on the back end, weekly.
Yep.
Week
So
by week.
Lynn,
Yes.
we work with the DOR and we share their courses on our website. So they're on the calendar
Wait a
on
second,
our.
Catherine. Remember, I don't hear well, so speak slowly.
Yeah, well, and this is really for the members on the call too. We share all these classes and we host, we share the information on them on our website. So they can go to our CPE calendar and it'll redirect them to the DOR's, the links to sign up for each of the classes with the information. So they can look on the SCAPA website on the calendar for the opportunities of these courses. It's something we share with DOR for the members so they can easily access it.
Thank you. Thank you. I thought I had discovered something unique. So thank you for pitching that in. Archiving frequently asked questions. This is an information release announcing that the IRS has really formalized its archiving process. But also, we had a couple of college professors that did some research I thought was interesting. On the Tax Cuts and Jobs Act, we had 138 formal guidance documents between 2017 and 19 about implementation of the law, while 202 documents were published on the IRS website or as news releases. That 202 documents, those are informal guidance. After the 86 Reform Act, we got 245 formal guidance documents, but only 80 informal guidance documents, things like frequently asked questions. So in this interim, in this 30-year interim, the IRS has moved more toward publishing guidance in the form of frequently asked questions. Our great frustration was we didn't know whether we could rely on them or not. And the IRS was reluctant to make that commitment. As that use of informal guidance grew, the IRS didn't clearly announce updates. So I had advised everyone, keep a copy of the FAQs and date them, write the date right on the front, on the date that you relied on them. So if the IRS changes those frequently asked questions later, you can go to what you relied on as some kind of a defense to avoid penalties. And of course, the IRS is saying, well, we're not sure you can avoid penalties by relying on the FAQ. This information release divides the universe of FAQs into two primary categories: those that are significant on newly enacted legislation and everything else. Fact sheet FAQs are now dated, so taxpayers can find out when the changes to the FAQs were made, and prior versions are going to be maintained on irs.gov, so you can locate the version on which you relied. One more thing. The new procedure adds a legend to a fact sheet FAQ regarding its authority for penalty protection. Right up front. Each FAQ is published will tell you whether you can rely on these FAQs for penalty protection, and it's about time. Extending penalty protection to taxpayers who reasonably and in good faith relied on archived frequently excused is particularly appropriate when those FAQs are the only guidance explaining a change in the law. Look here, pointing down. See that? That's a link to the where the IRS is putting up the list of FAQs. You can go there, find all of the FAQs. They're searchable. So the FAQs, as they have become increasingly reliable, and increasingly providing information for reliance, are now increasingly formalized, and we have ways to keep track of them and use them in a formal process. We get regulations now that clarify payments that are eligible for the foreign tax credit. The Transatlantic Trade and International Partnership over there on the left, euros and doctors and dollars flowing back and forth on the right. New rules determine whether amounts paid to foreign governments are considered tax payments eligible for the U.S. foreign tax credit. What do you mean? What do you mean? It's an income tax payment, right? Well, yeah, maybe, but they may not call it an income tax. Why is this so hard? Well, let's see. Why was a payment made or accrued and then paid when due? Why? Or what was the payment actually made or accrued? Number one. Two, who made the payment? That's the taxable entity that can claim the credit, either itself or with an affiliated entity that might have paid the credit, and you're filing a consolidated return in the U.S. Was the payment made? It's got to be, or why did you make it? It's got to be a tax on income. That's the hard part. If the jurisdiction doesn't use that term, how do we figure it out? Well, it will not be assessed on the value of property. It will be more or less based on revenue, or maybe revenue minus specified costs. It may be based only on revenue from one activity. You may be paying tax on your mining revenue, and you may be able to get a deduction for some expenses associated with the mining. I had that situation in Chile, where the government of Chile taxes your revenue from their mines, but allows only certain expenses, the expenses of extracting the minerals, to be deducted, and that income is subject to an income tax. And it might involve determining gains from holding or operating certain types of property. Where tourism is really important, there may be no tax on income from any other activity except operating a tourboat. And the expenses of operating the tourboat may or may not be deductible. Now, a tax on gross income may not be an income tax. That's why these regulations are so important. The good news is we got a wealth of guidance in court decisions. I had to laugh. I said, well, I'll just look up a recent court decision. So I found Mayor Basile, summary opinion 2021-20 back in the summer of 2021. He and his wife claimed a $3,500 foreign tax credit, but they didn't report any foreign source income. Oops. So if you're reporting foreign source income, there's a good chance you may have a foreign tax credit. You can either claim the credit or you can claim a deduction. That's a function of the difference between tax rates in the US and the foreign country, but it won't be a hard decision to make. Education is a tax-exempt 501c3 activity. I read 501c3, and an organization that is dedicated to education is a tax-exempt organization. Well, okay, but can it be an employee benefit? Well, that might change things a little bit. And it's certainly not in every case. What does that mean? Employers may offer education benefits in a few different ways. Tuition reimbursement, tuition assistance, employer-sponsored scholarships. And then there's Section 127, which allows up to $5,250 a year of direct assistance each year to an employee or for the benefit of the employee, not for the benefit of the employee's child, not for the benefit of the employee's spouse, but for the direct benefit of the employee. And that can be tax-free to the employee. The employer doesn't need to organize a separate 501c3 entity for that. And the employer education assistance programs can provide tax-free employee benefits in other ways. The plans have to be written, they have to be publicized to all employees, just like any other employee benefit program. So what happened here? This private letter ruling addresses a situation where the organization was formed to provide scholarships to the children of a company's employees, the children of the employees, not the employees. The IRS determined that the scholarships served a private purpose of the company, making them an attractive employer, but they couldn't be an employee benefit because the scholarships weren't going to employees. It constituted an employee incentive and a taxable employee incentive. They were not awarded for need or merit, and therefore the application for tax exempt status for the scholarship program failed. Now, a new fact sheet on the premium tax credit. Information release announcing the fact sheet, the new fact sheet, which you can find at that location I gave you earlier in this short program. New fact sheet addresses recent developments, the effect of unemployment compensation, and a number of other topics. So I couldn't get everything on one slide. And the people that tell us how to do these things say I shouldn't crowd a lot of information onto my slide, that you lose interest when I do that. So I'll go to the next slide. This fact sheet in the form of a PDF, about, I believe it's 18 or 19 pages, updates the basics, updates eligibility, updates reporting, updates suspension of repayment of excess advance payments of the premium tax credit, and new unemployment compensation FAQs for 20 and 21. So if you have questions about the tax credit, you want to go to the new FAQs, not the old ones, the new ones. Now it's time for Larry Pon to take the ball. He's going to talk about new regulation, proposed regulations. Highly anticipated is the adjective I picked up from tax notes. So I'm going to turn the controls over to Larry. If this thing works the way it's supposed to, Larry, you are now the host.
Okay, you need to turn off your share. It's a little red box that says stop screen sharing. So if you click on that.
Thank you. I need all the help I can get.
There we go. Okay, let me bring up the slides. Give me a second here to do that. Here we go. Let me fast forward to where you're at. But while I'm fast forward now, I'll just make a couple of quick comments of
just click the buttons 18 times, Larry.
Yeah, but I'll give some quick comments about some of the topics you already mentioned here. Yeah,
These folks don't expect us to be slick. They expect us to be useful and helpful with information.
That's right. So Yeah,
We don't get points for being experts at manipulating the software.
Okay, very good. So anyway, regarding the FAQs, I still recommend printing them out and putting in your files because I don't trust the IRS to maintain their website. Foreign tax credit regs, there are 366 pages. It's to help you fill out Form 1116. And the premium tax credits, that's form, what form is that for? It is form 8962, premium tax credits. So that's what this is all about. Okay, so yeah, we'll talk about these new proposed regulations that were just issued on February 23rd. And this is regulations on the Secure Act. The Secure Act was passed at the end of 2019, in December of 2019. It was the biggest change in retirement plans for quite a long time. And Secure stands for Setting Every Community Up for Retirement Enhancement. And two notable changes was that it raised the required minimum date distribution age from 70 and a half to 72, which I like because it makes the math easier. I don't want to count those 6 months. So age 72. And most importantly, it eliminated what's called the stretch IRA, to be able to stretch out inherited retirement accounts and create a 10-year distribution period for most designated beneficiaries of individuals who die in 2020 or later. So those are two of the biggest changes that these regulations talk about. It's proposed regulations. It was just issued on February 23rd. It's 275 pages. Now, these are proposed, so there might be changes by the time they go final. Also, if you have any comments to these regulations, the IRS is going to take comments from industry and professionals like us before they finalize them. So hearings are happening in Washington. Towards the bottom of the regulations, there's some details there on how you can participate in these regulations. So first of all, let's talk about the 10-year rule. So for non-spouse beneficiaries, they're required to distribute the inherited retirement accounts by the end of the 10th year after the decedent's death. So basically you have 10 years. It doesn't matter if it's a traditional IRA or a Roth IRA or 401k plan, 403b plan. However, the advice we've been giving our clients for those who inherit a Roth IRA, hold the Roth IRA for 10 years and distribute in year 10 because you'll have 10 years of tax-free growth. Well, these proposed regulations are making some changes here. So the proposed regulations is going to require non-eligible designated beneficiaries inheriting from retirement account owners who died on or after the required beginning date to comply with a 10-year distribution requirement in addition to taking RMDs during that period. So that's one of the biggest change that the regulations are adding, because this was not in the Secure Act when we got them, because we thought it was the 10-year rule was just like the old 5-year rule. It just has to be distributed within 10 years, no annual distributions. Now, earlier in 2021, in IRS publication 590-B, that's the publication distributions from IRA accounts, they mistakenly put in the publication that you had to take a distribution every year. And a lot of us tax professionals caught that, and the IRS made a correction. So they agreed that those distributions had to be taken during the 10-year period. You can, but you don't have to. But the regulations do change that. So before we go into these rules, let's talk about the types of beneficiaries that can exist. There's 3 kinds of beneficiaries. There's what's called an eligible designated beneficiary. That's a new category created by the Secure Act. And we'll talk about who those people are. But if you are an eligible designated beneficiary, you can take the stretch IRA retirement plan, which means you take it over life expectancy, which is what the old law was before the Secure Act. And then everybody else is a non-eligible designated beneficiaries, also known as designated beneficiaries. So they're subject to the 10-year rule. Now, just like the law before the Secure Act, there are what's called non-designated beneficiaries. So those are beneficiaries who are not human beings. That could be a trust, a charity, or anyone who's not a person, or someone, or in the case of of an owner who didn't name a beneficiary. It's a probate or something like that. So that's subject to the 5-year rule. And you could be subject to what's called the ghost rule. So that's the 5-year rule for non-designated beneficiaries. But we're going to focus on what the proposed regulations are talking about. So there's two. So the rules for the non-eligible designated beneficiaries is going to depend. It's going to fall into two categories. The first category are those who inherit an account for someone who died prior to the required beginning date, before they turn age 72. So if you are inheriting an IRA retirement account, you're subject to only the 10-year rule, which means I got 10 years to distribute the account. I can take 0 the first 9 years, take it on year 10, or spread it out over the 10 years. There's no requirement to take it during those 10 years. The second rule for non-eligible designated beneficiaries are those who inherit a retirement account for someone who died on or after their required beginning date, which would be age 72. So in that case, you're subject to both the 10-year rule and the regular stretch distributions. Now, how's that for simplification, right? So what that means is there's annual minimum requirements for each of the first 9 years after death. So this is brand new. This is in the regulations. We never got this guidance before. It wasn't in the instructions or an IRS publication. So the first 9 years, the minimum amount you need to take out is the required minimum distribution and fulfill the 10-year requirement. You got to empty the account by the end of the 10th year after death. So let's go over an example of this 10-year rule. So let's say we have husband and wife, Frank, who's 75, they die in 2022. The wife is Erin, she's 68, dies in 2022. He's subject to required minimum distributions. She is not. Their son, Jamie, is 40 years old. So he inherits both of their IRA accounts. For Frank's IRA, he's subject to the required minimum distribution. So Jamie will have to take distributions during the first 9 years based on the required minimum distribution calculations and empty it by 10 years. But for his mom's IRA, he doesn't have to take anything for the first 9 years, as long as he empties it by the 10th year, or he can take whatever amounts he wants depending on his tax planning. So this is how the proposed regulations are telling us what to do when you inherit an IRA. So if your clients inherit an IRA or a retirement account, we're going to have to ask, how old is the decedent? Are they over 72 or they're under 72? That's another fact we're going to need to know. We always have to ask a lot of questions when we're inheriting IRAs. The other question you always ask is, was there a Form 8606 in the decedent's tax return, which means there's basis in the IRA? Because the biggest mistake I see people make is they just assume the whole thing is taxable. There's a lot of people who have basis in their IRAs, and you inherit that basis also. So make sure you get the Form 8606 for the decedent, and hopefully the executor, trustee, or whoever can answer that question. So the proposed regulations also give us some more guidance on eligible designated beneficiaries, and we'll talk about that in a little more detail. So the most common eligible designated beneficiaries, so these are people who can still take the stretch IRA when they inherit an IRA. The first is a surviving spouse, and we'll talk a little bit more about that later. The second is a child under the age of majority. So when the Secure Act came out, we didn't have specific guidance on what that meant. It wasn't standardized before. We thought, okay, the age of majority is based on state laws. So we looked at all the different states. Some states are 18, some are 21, and all that. But the proposed regulations established that the age of majority is the 21st birthday. That's what the regulations say, 21st birthday. And so I was a little confused about that, because when the Secure Act came out, it had something about students up to age 26, and I don't see the proposed regulations talking about that. So what about students up to age 26? So that might be one of our comments to the IRS about finalizing this regulation. They might want to add a little bit about students up to age 26. However, for defined benefit plans, they can still retain whatever their prior definition is. So there's a little bit of a carve out in the proposed regulations for defined benefit plans. And so defined benefit plans are pension plans, basically. That's what that is. So here's an example here of a child, example of a child. So we got Jay, he's 75. We got Gloria, she's 45, husband and wife. They both die in 2022. They have a 5-year-old son, Joe. He's the beneficiary. So Joe is a minor child of both decedents because he's under age 21. So he can take the RMDs up to age 21 because he's a eligible designated beneficiary. And then after he gets to age 21, then he's subject to the 10-year rule. So for the first, let's see, he's 5. So from 5 to 21, he can stretch the IRA out, take the RMD based on his age at that time. However, once he hits 21, he's got 2 sets of rules to follow for each inherited IRA. So for Gloria's IRA, he's got to distribute it by the time he's 31. He can leave it and just distribute by age 21, which means from age 21 to 31 or age 21 to 30, it's 0. He could have 0 distributions, take it all, remaining at 31. However, for Jay's IRA, because he's 75 over age 72, subject to RMDs, he's going to need to continue to take the RMDs from age 22 to 30. He's going to have to take at least that amount of distribution and then empty it by age 31. So that's the example of a child. Okay, the next eligible designated beneficiary is a disabled designated beneficiary. We weren't completely sure what that meant when the Secure Act passed. We kind of guessed at it and all that. Now the proposed regulations have given us a little more guidance on what that means and some new rules for us because we didn't have this guidance before when the Secure Act passed. So it depends on the beneficiary's age. If the beneficiary is under 18 at the time of the owner's death, the child must, or the beneficiary must have a medically determinable physical or mental impairment that results in a marked and severe functional limitations, and that can be expected to result in death or be long, continued, and indefinite duration. So that's the rule for under 18. Over 18 is a different standard. Over 18 is under 72M7, is based on an inability to engage in substantial gainful activity. The proposed regulations gives us a safe harbor. If the beneficiary is considered to be disabled for Social Security benefit purposes, you're considered to be disabled. And that was the guidance we got when the Secure Act passed. So that's for over 18. So 2 different sets of rules depending on age of the beneficiary. Now, the proposed regulations has some more details on how to document this. So you're going to need a doctor's note, and it even goes to details of what doctor. So it can't be that chiropractor down the street, or you can't just buy an opinion. It's got to be your doctor who's licensed and in good standing. So yeah, they're pretty strict about that. And then there's some more guidance on what is a chronically ill individual. What's a chronically ill individual? So you have to have written documentation to the plan administrator or the IRA custodian by October 31st of the death after the decedent's death. So you need to include a certification from a licensed healthcare practitioner verifying the inability of the individual to complete 2 or more activities of daily living for at least a lengthy period of time. The earlier rules said 90 days. They took out 90 days. They changed it to lengthy period of time. So that's a little change of language there. And examples are grooming, dressing, toileting, ambulating, eating, and transferring. So if you're missing 2 of those, you can be a chronically ill individual. Now, there's some more confusing guidance that I'm not going to go over here, because what if you change categories or something like that? So that's another 2-hour discussion. I'm not going to go there. So the last eligible designated beneficiary is an interesting one.
Could I ask a question?
Yeah, fire away, Lynn.
Back up 1 slide, please.
Yes.
That list, that appears to be the same list that we've used for a long time, determining disability for purposes of early distributions from an IRA.
Exactly.
So there's that's no change, no different.
Very similar, right? Same thing for long-term care. So
Thanks.
yeah. So but again, the regulations go into very deep detail about who can write this letter. The controversy we hear is there's a chiropractor down the street who's just selling letters. Well, you can't do that. Okay. The last type of eligible designated beneficiaries are individual no more than 10 years younger than the decedent. So those beneficiaries can still take advantage of the stretch IRA. So there was some question about that. Is it the actual age, the actual age of the person, the actual age of the beneficiary, or is it a calendar year? He was born in 1970 and the beneficiary is born in 1980 or 1990 or whatever. Was it a calendar year? Because there's a lot of parts in the tax code with respect to retirement plans, it's based on the calendar year, not the actual birthday. Well, the proposed regulations say it's the actual age of the decedent and the actual age of the beneficiary. So here's an example. We got Mitchell. His date of birth is July 1st, 1970, dies in 2022. His sister Claire's date of birth is March 1st, 1980. And his brother-in-law, BIL, Phil, who's also a beneficiary, is born on August 1st, 1980. Well, Claire is 9 years and 8 months younger than Mitchell, so she is an eligible designated beneficiary, so she can stretch the IRA. Well, Phil is 10 years, 1 month younger than Phil, so he's a non-eligible designated beneficiary, so he's got to distribute it by the end of 2032. He's got taken within 10 years. So that's for the 10 years or younger. So the regulations, was it 275 pages? It's a good read. There's a lot of FAQs in there. So it's relatively easy to read. Now, there's some confusion when the Secure Act passed about surviving spouse because it made reference to the original date, 7.5. So before the Secure Act, the surviving spouse who remained the beneficiary of the deceased spouse's retirement account is not required to take RMDs until the deceased spouse would turn 70.5. Now, if the surviving spouse died before that date, then the spouse's beneficiaries were treated as though they had inherited directly from the original account owner. I want to make a quick comment on that because I had so many cases where the surviving spouse never updated the beneficiary designation, didn't name the children. She named her spouse, but he died. And so we were forced to go through probate, which is an expensive, lengthy process. If you go through probate, you're not a designated beneficiary. You're a non-designated beneficiary, which means you got to take it over 5 years instead of 10 years. So my tip for the day is review your client's beneficiary designations. Sometimes you see a name and you go, who's that? Oh, that was 2 wives ago. Well, you better update that. Or worst off, you named a girlfriend. Are you serious? So anyway, check the beneficiary designations. So the proposed regulations states that surviving spouses remaining as beneficiaries of such individual accounts will not be required to take RMDs until the year the decedent would have turned 72 if the decedent was born on or after July 1st, 1949. Now, and the same thing as the previous law, that if the surviving spouse is still the beneficiary of that decedent's retirement account and her children are named, or who her beneficiaries are named in there, it'll be treated as if it was inherited directly from the account owner. So there's some tax planning here for surviving spouses, some decisions we need to make. Should we leave it in the name of the decedent? Should we roll it over to the surviving spouse? It's all going to depend on the age of the surviving spouse. If the surviving spouse is under age 59.5, you might want to leave it in the decedent's IRA, because if you take any distributions, it's not subject to penalty. There's many tax court cases where the surviving spouse rolled it over into her IRA, and then she's under age 59.5, took distributions. Those are subject to early distribution penalty. So watch out for that. There's been a handful of court cases on that, tax court cases. Now, this was hinted at in the IRS publication 590-B, which got us all confused because it wasn't mentioned in the Secure Act, but it was in the IRS publication 590-B. Now, IRS publications are not law. It is guidance, but it's not law. But so a lot of tax commentators weren't really sure where the IRS was going with that. But now the regulation says that the eligible designated beneficiaries can opt out of the stretch and use the 10-year rule. But you have to check with your plan administrator or IRA custodian because some would allow it, some wouldn't. So it depends on the plan administrator or IRA custodian. There's a whole lot more minute details about this. I'm not going to go into here because it's just a bit much, but you can opt out. But frankly, why would you? You want to stretch it out to pay less tax and let the money grow tax deferred. And then there's a lot of discussion about see-through trusts. Now, in today's discussion, we don't have enough time to talk about trusts as beneficiary of IRS. That's a whole lengthy discussion itself, controversial discussion, but this is why you want to double check your client's beneficiary designation. Some people have named their living trust as a beneficiary or an irrevocable trust as a beneficiary. So there's some special rules to see if they qualify as a see-through trust. And a see-through trust means the way the distribution is treated is based upon the ultimate beneficiary. So if the ultimate beneficiaries qualify as disabled or chronically ill, then the trust can retain those distribution factors. But the regulations go to a lot of details in there. So there's but they do allow for it. You just got to follow some careful rules. There's additional guidance, extensive guidance on determining which of a see-through trust beneficiaries can be treated as beneficiaries of the owner. Generally, if the trust is not a see-through trust, it's subject to the 5-year rule. It's got to be distributed in 5 years. So that's a big discussion there. And at the very last sentence of the regulations, talk about what's the applicable date. Well, hearings are going on right now, or there's some dates of hearings, but they are retroactive. So these proposed regulations, once they go final, don't know when that's going to be, but stay tuned for that. And also when they do go final, we'll need to read them again to see how it changed from the proposed regulations, but they'll be effective starting January 1st of 2022. Now, for the 2021 distributions, for the tax returns we're working on, obviously that's before we got these regulations, taxpayers can take into account a reasonable and good faith interpretation of the Secure Act. So again, document how you're arriving at a position, such as this person is an eligible designated beneficiary, especially with the disability definition and the chronically ill definitions. So stay tuned. And we'll see what happens when the final regulations come out. And this is just an overview. There are a lot more provisions in here that I didn't go over because they're pretty obscure and they won't affect most of our clients. So thank you for your attention.
Larry, thank you so much. I want to add something to that last slide. You have control of the slides, by the way, so you'll have to click us out, but not quite yet. Okay. You got to go the right direction. You got to go.
Okay, which slide do you want to go to?
I want to go just the last one before this one.
One before this one. Okay.
There you go. Okay. The reasonable good faith interpretation, that one defense of your reasonable good faith interpretation can be that you discuss this with other qualified professionals. So if I'm just operating on my own seat of the pants reading of the regulations, I might have some exposure. But if I call Larry and he agrees that we can take a position, I'll just put a note in the file. But I've made a reasonable good faith effort to comply. And so I want to just add that. Now let's see, you can press the button to 4. There we go. That's you.
That's me.
And that's how they contact you. There's and you're going to download the material. You'll have Larry's address. And if you lose it, I have it. So let's continue to meet for lunch, please. This Zoom call happens every Thursday at noon. It will be always interesting, occasionally exciting when we screw up the technology. And from time to time, we'll have an interesting guest like Larry. Do you have a question? Maybe one you didn't post. It's not too late. Put it in Scapa Connect. I check that every other day or so. And I respond to questions in Scapa Connect on a regular basis. So, and like today, you can mute and unmute to contribute to the discussion. One more clip, Larry, and I think we're done.
Yeah. Well, and I want to do a shameless plug. Both Larry and Lynn will be with us at Spring Splash in May in Spartanburg. So we hope that you'll consider joining us at Spring Splash and you get to meet both of these guys in person. So look for May 12th and 13th and keep it on your calendar.
Thank you. Does someone have a question?
Yeah, I do, Jackie Amerson. So my mom passed last year, 2021. She was already 74 when she passed, and I inherited a Roth IRA from her. I elected to, open up an inherited IRA, Roth IRA, and rolled it into my account. And I was anticipating leaving it for 10 years and then taking it out at the end of 2031. I'm assuming there's not going to be any required minimum distribution since it's a Roth, even under the new regulations. Is that correct?
Right. These regulations aren't going to take an effect until January. So she passed away in 21. Yeah. So that's before we got these regulations, before we got this guidance. So, and there was a hint of it in publication 590-B, but a lot of tax pundits weren't really in agreement with it because there's no authority for that. Well, the regulations gives the IRS some authority. So for decedents who passed away in 2021, for Roth IRAs, let it sit for 10 years. You get 10 years of tax-free growth. That's a pretty darn good deal. The challenge I have is for the young beneficiaries. Like, can you wait? Can you wait? Can you wait 10 years?
Thank you so much.
When you're young, 10 years is a lifetime.
I know you know how many new cars I've seen in my parking lot when there's an inheritance. It's like, or a classic car. It's like, oh, okay, I know where that went.
Alex, do you have any speech for the good of the order before we go? I see Alex.
I don't, Lynn. Thank you.
Thanks. Thank you, everyone. See you next week.